But in March of 2020, if we were to look at that month and we say what happened, well, I think that's the month where the inflation rate tripled. And I think if you can imagine 7% is 2%, but it's hard to imagine that 21% is 2%. And if it's not 2%, then it's material. So I think that that was a shock in March. And I think the K-shaped recovery was proof. When I watched CNBC and I saw people talking about how, well, cruise lines are shut down, hotels are shut down, theme parks are shut down, airlines are shut down, movie theaters are shut down, Disney stock hits an all-time high, and somebody goes on television and says, well, we're valuing Disney stock based upon 2024 revenue multiples of Disney Plus. And I thought, Disney owns cruise lines, theme parks, theatrical releases, retail. They're all shut down, and they just launched a streaming service, and someone has just decided to value the company not based upon this year, not based on 5% of this year's number, but based upon not next year's number, not the following year's number, but 4 years from now, we're going to value this company based upon one of 20 lines of business, which is currently just being incubated. And it's all with a straight face. Everybody's buying it. The stock's hitting an all-time high. I'm scratching my head. And now you start saying, well, why is this? And that's an example of monetizing an equity. Where you bet, what are you doing? I'm basically just pouring a bunch of money into the economy, and it has to find a home. So let's just monetize the brand. We like Disney. We might as well just go ahead and double the stock price in Disney. The fundamentals, well, if we just go out 4 years and focus upon the speculation of 5% of the company 4 years from now, it doesn't seem very risky now, does it? Right? At that point, right, what do you have shattered, right? You've shattered all your illusions about bonds because interest rates pegged to zero. You've shattered, and they're pegged to zero forever, right? And there's nothing rational, fair, equitable, normal about 30-year money. Like, what's the 30-year rate today? 170 basis points for the government bond. This is today. Like, by and by, the interest rates will go up. Oh, well, there's no inflation. Okay, well, I guess there's 5% inflation, but it's transfer. Well, I guess there's 6% inflation is not transitory. And the interest rates went down. Why are they going to? Well, the Federal Reserve is going to raise the interest rates now to fight the inflation. So I guess we don't have to be concerned about, but it's so odd, right? The logic that if you thought that the world was composed of stuff you understood, right? We stack up all the things in the world you think you believe and you understand, and we smash them one at a time. So the $100 trillion worth of bonds are, and sovereign debt, that's smashed when the interest rate's pegged to zero, and when the 30-year yield is, the 30-year swap rate in the US is 165 basis points. But the 30-year swap rate in Europe, like 30-year European money, is like 25 basis points. So for 1/4%, you could borrow money for the rest of your life in the euro. Okay, it's been pegged, it's been sitting on the floor, right? So if interest rates the value of time, the value of your time is driven to zero. We've declared war on time.